Good morning, all you magnificent melonheads of the world. I hope you guys are doing well this morning. Today is Wednesday, October 16th, 2024. The top story this morning is the semiconductor industry chips. AI mania. It's so amazing. It's everywhere. Oh my God. We're going to be laying everybody off because chatbots are going to replace assembly line workers and garbage men and waiters and waitresses somehow because reasons. And yet, ASML yesterday, in a rather laughably, kind of hilarious fashion, they accidentally posted their financial results to their website a day early, their pre-announcement. And within those results, pretty alarmingly, was a 53% drop in bookings. Now, ASML Holdings, if you guys aren't familiar with this company, they're a semiconductor manufacturing equipment maker. They make the stuff that makes the chips. So, Taiwan Semiconductor, for example, they build NVIDIA's chips. Well, the equipment at Taiwan Semiconductor's factory comes from ASML Holdings. So, we're talking about the guys upstream of NVIDIA, and they're saying a 53% drop in bookings, a 53% drop in their future orders. Now, also within that accidentally published to our website financial results was a 20% increase in net sales. So currently they're doing great, but in the near future, they're going to drop off a cliff. And remember, guys, what I've been saying for more than a year now is that this AI mania is a bubble and that everybody is just shoveling tens of billions of dollars at this issue, saying it's the next best thing, but nobody is making any money off of it. NVIDIA is making money, the chip makers are making money, the people who are renting out the GPUs to the AI companies, they're making money, but the AI companies are not. They are just cash burning machines, drunken sailors, college students, wives with credit cards. Oh, I just got the feminists mad at me. They just burn through cash. That's all AI companies do. They don't make any. Most of them don't even have viable, marketable products. All they have is promises and PowerPoint, and there is very little power in these points. And so, the AI mania, this bubble, it's going to pop someday. It's going to pop violently. Bubbles don't slowly deflate, they go all at once. And maybe, just maybe, this accidentally released 53% decline in bookings for the people who sell the equipment that makes these chips that supposedly there is this insatiable appetite for, maybe, just maybe, that was really hot air all along. Also, guys, the mainstream press was all over this one yesterday. Every article about this ASML accidental release was so quick to say, don't worry, it's non-AI applications. Oh, the demand for AI is still amazing, but it's computers, it's iPhones, it's anything but AI. Don't worry, whatever you do, don't damage my AI narrative because my advertising revenue might be at stake. Or hey, all the people, the wealth management companies that pay to advertise on my network, well, they might pull their advertising if they can't convince retail to just pile blindly into tech stocks. And so it seems like the mainstream financial press is running interference on this story, being very careful to say, don't worry, it's not AI, it's everything else, even though there was nothing to that effect in the ASML release. ASML didn't say that. The financial press is just projecting that onto this story because reasons. Again, we don't know why they're, well, I suspect I know why, but there is no supporting evidence to say that this 53% drop in bookings has nothing to do with AI other than they just really hope that's the case. Now, on top of that, we got mortgage application data out today. The 30-year mortgage rate spiked 16 basis points last week. And that is the second week in a row of big increases in mortgage rates, a combined 38 basis point raise in mortgage rates in the last 2 weeks. And that is having a predictable effect on the housing market. Applications for mortgages dropped by 17% for the week ending October 11th. That included a 7% decline in applications to buy a home and a 26% decline in applications to refinance a home. So the housing market remains frozen. Refis remain highly susceptible, highly volatile, and vulnerable to changes in interest rates. And remember, guys, long-term mortgage rates, they've done nothing but go up ever since the Federal Reserve lowered interest rates. And it was something I was warning about for several months before the Fed cut finally happened. I said, hey guys, the Fed only controls that overnight rate. The Fed does not control mortgage rates. The Fed doesn't control auto rates. They don't control the long end of the yield curve, only those overnight rates. They can exert influence on them, but really things like risk among borrowers, counterparty risk, things like long-term inflation expectations, they have more of an impact on those long-term rates than the Federal Reserve does. And well, look at what's going on today. Gold within striking distance of an all-time high. Silver is pushing $32. Bitcoin is above 68,000, I think, at this point now. All of these dollar hedge trades, all of these fiat currency alternatives are pushing near all-time highs right now. Maybe the reason why interest rates are rising on the long end has a little more to do with long-term inflation expectations, a little bit less to do with what the Federal Reserve may or may not do. Also in the news today, True Value Hardware, the holding company, the wholesaler behind the retail True Value stores, they're going bankrupt. Now, True Value is a network of independently owned hardware stores, but you have the True Value parent company that controls the wholesale distributors. That is a single conglomerate. They're going bankrupt. They're selling it to their rival, Do It Best. Look, this goes right along with that frozen housing market, guys. If people aren't buying houses and people aren't moving, then they're probably going to the hardware store a lot less. We've also seen things like Big Lots bankruptcy, L&L Flooring bankruptcy, Home Depot and Lowe's are posting pretty lousy quarters, terrible year-over-year same-store sales growth. And so True Value Hardware is going under. That is an old name, a long-standing name. The trouble in the auto sector continues. We had Chrysler reported sales declines of 15%, but deliveries were down 20%. That's interesting. When your deliveries are dropping faster than your sales, Chrysler is telling us we don't expect our sales to get better. The dealers are trying to reduce their inventory. They saw a lot of inventory growth last year. They ordered way too many EVs. They built way too many EVs. And most notably within this report, a 36% decline in vehicle deliveries to North America. That's your US market, guys. There is trouble brewing in the car space. And look, we've had my buddy Tommy from Car Concierge Plus on the channel a couple of times in the last couple of months, and he's been saying these prices are coming down. It's a buyer's market again, and it looks like these prices are going to keep coming down. So if you're in the market for a vehicle, it's not a terrible time, and it's also not a bad idea to wait a little bit, because if we're seeing these deliveries drop 36% in North America because they're trying to reduce their inventories, that means we're probably seeing some big price cuts on the horizon, even though the CPI numbers for new vehicles actually went positive in the last CPI result. And then on top of that, we've got another really rough one today from LVMH. That's Louis Vuitton, Moet, basically luxury item maker, everything from handbags to champagne and I don't know, all that stupid stuff rich people blow their money on. They're reporting a big slump in sales in China. The Chinese consumer is in bad shape. And this article, the CFO of LVMH is basically saying the consumer in China is as pessimistic as he was at the height of the vid. And you guys remember at the height of the pandemic in China, the Chinese consumer was not consuming at all. He was like welded shut in his apartment and unable to go out and shop. And they're making comparisons to that in this report from LVMH today. The things in China are not, what am I saying? They are not nearly as good as they're saying, or things are a lot worse than they're willing to admit to. And when you see statements like this from LVMH, from a luxury consumer brands company, it kind of starts to make sense why China is trying to opt for this fire hose of stimulus that so far has been more hype and less substance. But the situation on the ground in China, probably a lot worse than the Chinese Communist Party is willing to admit. Surprise, surprise, it's hard to get accurate information out of China. But don't worry, guys. Morgan Stanley's earnings are out, and the rich people here in the U.S. are doing fantastic. Morgan Stanley posting huge year-over-year growth numbers in things like wealth management, equities trading, and investment banking. So you can't afford a car, you can't afford a Louis Vuitton handbag, you can't afford to shop at True Value, but at the very least, Wall Street is doing fantastic. So you guys can enjoy that silver lining to that big gray cloud. Why don't we shrink my big melon of a head and let's see what is going on in this market today? And if you could hit that big, beautiful thumbs up button. And if you're new here, hit that subscribe button as well because we do this one every morning. Come and have your coffee with the melon heads. S&P 500 is positive, just barely here, up about 4.5 points this morning, 0.08% higher. The Dow, meanwhile, is down about, well, not even 1 point, basically going nowhere on the Dow. The Dow had a rough day yesterday, driven mostly by those United Health earnings. And the NASDAQ is actually in positive territory here, up 35 points. That's despite continued performance from those semiconductor stocks this morning. The dollar, meanwhile, is a little bit stronger here, up 7 basis points, 103.33 for the U.S. dollar. And looking at the bond market, we've got yields are lower pretty much across the board here. The 30-year Treasury, 4.298. That is down 3 basis points. The 10-year yield, 4.012. That's down about 2 points and change here. The 2-year, 3.942. That's down 1.5 points. And the 1 month is actually up a fraction of a point at 4.807. Looking over at the commodities board, we got a lot of green this morning in commodities. And check out the shinies. Is that an all-time high for spot gold? It is very, very close, if not an all-time high there. We'll check in a second. $2,682 for spot gold. We've even got December gold futures pushing $2,700 right now. Again, guys, tell me inflation is coming back without actually telling me. Look at gold run here, up $18, $19, about 0.75%. Silver's getting in on the action too. Spot silver's at $31.91, up 40 cents, about 1.3% here. Even December silver futures are above $32 this morning. Meanwhile, we got copper's up about 0.8%. Platinum is up 0.75%. Palladium is up 0.5%. WTI crude is modestly positive here, essentially unchanged at $70.61. No new developments in the Middle East as of today, so we're still sitting here waiting, wondering what the Israelis will do, if anything, but oil is not moving today. You know what is moving? Check out Bitcoin, $68,232 as priced on Coinbase. That's up another $1,176 or 1.75% today. We were talking about this trend yesterday, guys, this bull flag pattern that Bitcoin has been in after that long run up that we saw associated with the Bitcoin ETFs getting approved at the SEC. Ever since that initial hysteria for the ETFs wore off, we've seen Bitcoin bouncing up and down in this bull flag consolidation pattern. And then this week, we broke out of that. Give me where is it? Where's my marker here? Oh, my marker's not working. Anyways, we broke out of that pattern this week. Now at 68,232. Next resistance is that psychological level of 70,000. We break above that, guys. Bitcoin has an all clear. I mentioned this yesterday. I think we're going to 100,000 in pretty short order if we confirm a breakout of this pattern, which it looks like we're about to do. And gold is also, there it is, not quite an all-time high for gold here. We are sitting at 2,682 today, looking pretty good here. The all-time high was just a little bit higher for spot gold. It looks like around 2684. I'm going to go ahead and call this a new all-time high for gold because I suspect we're probably going to be there momentarily. Congratulations to the stackers. I like the shiny. Silver's doing the same thing here. Not quite an all-time high, but it is running as well. 31.92 for spot silver. Watch this level just above $32, guys. We failed to break above this one. Back in May, we hit it a couple of times. Then we came back up here a few weeks ago at the beginning of October, the end of September. Failed to break above it there. We're going to make another run at this level here. We'll see if we break above. And I just want to zoom out on this chart, guys. If we do break above that level, you can see there's silver squeeze. There is no resistance anywhere near here. If we break above this $32 level and then confirm the breakout, to get anywhere near a resistance level, we're going to have to set this thing to monthly candles and zoom all the way out to 2011 when silver was approaching $50 an ounce. So silver is looking really good here, but we got to break above this current level before we celebrate. Let's not get premature here. All right, now let's talk about what happened in chips yesterday. This story was crazy. ASML plunges after leaked Q3 results and a 2025 downgrade. ASML Holdings, Europe's semiconductor giant, faced its worst one-day stock decline since 1998, falling over 15% yesterday. It's down again this morning pre-market here after an unintentional early release of its third quarter earnings. The leaked results revealed a 53% drop in bookings, far below market expectations. That's despite a 20% increase in net sales to $7.5 billion. This discrepancy between strong current performance and weak future demand triggered a broad sell-off as investors scrambled to reassess the company's growth trajectory. Now, that's the thing, guys. This big delta, this big difference between the current level of sales and those bookings dropping 53%. That looks like a bubble about to burst. That looks a lot like a bubble about to burst. This bubble that everybody's in denial that it even exists. And Andrew Ross Sorkin is giggling like a schoolgirl when Jensen Huang wanders onto the set of Squawk Box in the morning. Guys, I've been warning about this for a year. This does not make sense. There is no underlying business supporting these ridiculous valuations of these AI stocks. Chatbots are neat. Chatbots are cool, but they hallucinate. They spit out totally incoherent, incorrect answers half the time. And so you can't rely on them for anything accurate. At best, they're a productivity enhancing tool. At worst, they're going to wreak havoc on the world. They've already totally shitified the internet. But hey, glue your pizzas together. Good luck with that. And here we go, a 53% drop in bookings. The orders are not out there in the future. But the real hit came from ASML's revised 2025 forecast. The company lowered its sales outlook to 30 to 35 billion, down from the previous 30 to 40 billion. This revision stems from delayed demand to ASML's EUV lithography machines, crucial for manufacturing next generation chips. While the boom in AI related chips remains strong, other segments, such as logic and memory, are recovering more slowly, adding to investor concerns about longer term growth and profitability. And I don't know where they're getting this. Where did Yahoo Finance get this thing? That don't worry, the boom is still going on in AI. That was not published on ASML's website. They're just projecting that. And you can see that all over the place in this Bloomberg article this morning, talking about how the sell-off in AI or sell-off in semiconductors wasn't just ASML. Global chip stocks erased $420 billion worth of market cap after the ASML sales warning. The magnitude of the forecast cut was a surprise, Citi says. And even peer Tokyo Electron, that's the rival semiconductor manufacturing equipment maker, they were also down 10% on this news yesterday. Investors in chip stocks are facing a fresh gut check after a tepid outlook from a key equipment supplier. ASML Holdings sparked a global rout in this sector. Combined market value losses for an index of U.S. traded chip makers plus the largest Asian stocks reached more than $420 billion. The warning from Netherlands-based ASML halted a rally that had pushed a gauge of U.S. traded shares to a 3-month high. ASML shares tumbled by the most since 1998 after the manufacturer of the world's most advanced chip-making machines cut its outlook on sluggishness in areas beyond AI. Again, this is the press projecting here, saying it's areas beyond AI. That's not what the company said. They lowered the top end of their guidance for 2025's total net sales to 35 billion. That's in euros, which is about 38 billion, from 40 billion euros. While the weak 2025 forecast was expected from ASML, given slowness in non-AI applications, as well as reduced spending by Intel and other factors, the magnitude of the correction is a negative surprise. Exacerbating the situation was the lack of accompanying color. And that's what I don't get. That all these media outlets are like, don't worry, it's not AI, it's non-AI applications, despite strong AI. And then they go on and say there was no accompanying information. Well, then where are you getting this information that allows you to say it's not AI, it's the other things? You might as well say it's not AI. I just want to be friends. We're still going to be like, I don't know where they're getting this information. The results were released mistakenly a day earlier than scheduled. Shareholders are accustomed to a well-oiled machine of investor relations to explain the workings of the business and the timing of orders, bookings, revenues, and shipments. Investors will focus on the post-earnings call scheduled for 15, what's that, CET? I think that's European time today. Look, ASML stock, look at this thing, down 16.26% yesterday. It's down another 3.4% today. This is priced in US dollars, trading at $705.97. So you can see the stock just dropped like a rock yesterday, falling again today. And it wasn't limited to ASML. This is the VanEck Semiconductor ETF, ticker SMH. That one was down 5.4% yesterday. It's recovering about a 0.5% this morning ahead of the open. This really took chip stocks for a ride yesterday, guys. Again, maybe, just maybe, this really is a bubble. And that's why we're seeing a 53% drop in bookings for the people who make the equipment that makes the equipment that powers artificial intelligence. Now let's shift gears a little bit to mortgage rates here. The United States 30-year mortgage rate, the average contract rate spiked to 6.52% for the week ending October 11th. That is the highest in about 2 months, compared with 6.36 in the previous week. So we got a 16 basis point increase in mortgage rates. That is now 38 basis points in 2 weeks. Mortgage costs rose for a third straight period after hotter than expected inflation print reinforced bets that the Fed will lower borrowing costs at a softer pace. It's interesting that they're chalking this one up a little bit to a hotter than expected inflation print. That, yes, inflation was a little hotter than expected, but the press downplayed that big time. I think it's probably got a little more to do with that stronger than expected jobs report that I was very skeptical of. But you can see in this chart here, this is the average 30-year mortgage rate. It had been rising all through 2023. It fell rapidly last fall. It's been falling most of this year. And then we've gotten these last 2 weeks, we've had quite a bump up here. Now, that had an outsized effect on the mortgage market. Mortgage applications in the U.S. sank by 17% from the previous week in the second week of October, extending a 5.1% drop from the previous week to record the sharpest weekly contraction in mortgage demand since 2015, when excluding the period of unprecedented volatility at the start of the vid. The plunge in volume of mortgage applications was in line with a sharp increase in benchmark mortgage rates, as the strong jobs report and hot inflation print triggered less dovish expectations from the Federal Reserve and lifted long-dated Treasury yields. I would add, I think long-term inflation expectations is playing a role here too. See also gold, see also silver, see also Bitcoin, but that's just my opinion. Applications to refinance a home loan, which are more sensitive to short-term changes in rates, plummeted by 26%. In the meantime, applications to purchase a home sank by 7%. So once again, refis are more susceptible to spikes in interest rates, big time, 26% decline in those refi applications. And if you're not refining and you're not buying a house, then I guess you don't need to shop at True Value Hardware. True Value declares bankruptcy and sells itself to a rival hardware company. True Value, a 75-year-old hardware store brand, has filed for bankruptcy and is selling substantially all of its operations to a rival, the company announced on Monday. In a press release, True Value said it will continue day-to-day operations of selling hardware and other homeware tools to its 4,500 independently operated locations during the Chapter 11 process, which includes a $153 million stalking horse bid from rival Do It Best. So Do It Best is going to be buying what's left of True Value's wholesale division out of bankruptcy. Those 4,500 stores, they're not going to close. They're going to stay open. At least initially, it looks like nobody's going to lose their jobs here. These are just the suppliers of the True Value stores. So your neighborhood True Value is probably not going to be immediately affected by this. True Value said its stores will remain open because they are not part of the bankruptcy proceedings. In bankruptcy court filings, True Value said it faces a significant cash crunch as the housing market stalled and consumers have become far more picky about discretionary purchases like hardware. Bigger rivals like Home Depot and Lowe's have also been in a years-long slump since the pandemic boom, but they remain in significantly stronger financial situation than True Value. Still, a number of other chains have voiced similar problems that also tipped them into bankruptcy, including Big Lots and LL Flooring. So, guys, the housing market frozen. It's having downstream effects on hardware stores. It's also affecting Home Depot and Lowe's to a lesser extent. And we've got consumers are in big trouble overseas in China. LVMH fall from grace in China rattles luxury investors. 18 months ago, LVMH shares were trading at a record high, and the group's controlling shareholder, Bernard Arnault, was the world's wealthiest person. Fast forward to Wednesday, and a slump in Chinese demand for Louis Vuitton bags, Dior gowns, and other high-end fashion has wiped out more than 150 billion euros in LVMH market cap. Arnault's wealth has been relegated to fifth place amid a downturn that's dashed any prospect of a soft landing in luxury. Huh. Dashed any prospect of a soft landing in luxury. That's pretty interesting, guys, because the last time I checked, luxury was doing a hell of a lot better than everybody else. See also true value. And now they're saying dashed hopes from the soft landing. This is an unusual bit of honesty from Bloomberg here this morning. Now this is great. Tell me, when the CFO of a company says, I have no idea, is that a good thing? I'm asking for a friend here. I've no idea, said LVMH CFO Jean-Jacques, something I can't pronounce, on Tuesday when he was asked about the outlook for the company. The visibility of our business is as good as yesterday's sales. We've been through ups and downs. The only thing we know, when the business is bad, usually it's good thereafter. It's a cyclical business. That's great, right? Isn't that's wonderful insight from the CFO? Let's give this guy another billion euros worth of stock options because we got that wonderful answer. I don't know. Sometimes sales are bad, but they're good after they're bad sometimes. That's really wonderful insights from the chief financial officer there, Mr. Jean-Jacques, something I can't pronounce. Asia, excluding Japan, the region that includes China, saw organic sales tumble 16% in the third quarter, a bigger decline than expected. That was the third negative quarterly performance in a row, a 16% decline in organic sales in China, guys. The Chinese consumer is not spending. That's also something I've been warning about for years. Beware the wealth effect in China. When people's homes go down in value, they consume less, they feel poorer, and so they spend less on discretionary items. And in China, where the average person has a disproportionately large amount of their wealth, their net worth tied up in real estate, in my opinion, the wealth effect in China is going to be that much more dramatic, and we're already seeing it with LVMH's results here, a 16% decline in just the third quarter. Consumers in China, in particular, have curbed spending amid worries related to a weak property market and uncertain employment outlook. These concerns have prompted Chinese authorities to launch a stimulus package last month that's yet to show a positive impact on consumers' appetite. It has sent stock prices sharply higher, but it hasn't affected consumers yet. Consumer confidence in mainland China today is back in line with the all-time low reached during COVID, said that guy again, who I can't pronounce, Guiani. I don't know. How do you say that? French guys out there, help me out with this one. It's currently hard to assess the potential impact on demand of such measures, he added, but it shows that they are taking the issue very seriously. So a big time decline in LVMH shares or LVMH sales in China. That stock down 4.4% today. This one is priced in euros, I believe. It's currently trading at 598.1. The consumer in China is not doing well. The housing market is not doing well. And the auto market is not doing well. Chrysler and Jeep makers sees North American deliveries dive 36%. Stellantis' third quarter shipments dropped 20% on slower sales in North America. Guys, there is big trouble brewing in the car market. And pay attention because Michigan is an important state in this presidential election. And we just saw a big spike in jobless claims in Michigan last week. Europe's largest car maker, Stellantis, on Tuesday reported a 15% slump in its third quarter sales and a 20% drop in its shipment of cars worldwide, driven by a sharp decline in North America. The automobile manufacturer, which owns brands including Citroën, Chrysler, and Fiat, said it had delivered 279,000 fewer cars to customers and retailers worldwide in the 3 months ended September 30th. That's compared to last year. The slump in Stellantis deliveries was sharpest in its largest market, North America, where the Dutch company's shipments fell 36% by 171,000 units in the third quarter of 2024 to a total of 299,000 units. A big drop in shipments in North America for Stellantis here, guys. They're not forecasting good things on the horizon for the car market. Now, they had smaller declines in Africa, the Middle East, and in Europe as well. But Stellantis noted that the 20% drop in its shipments was more severe than the 15% drop in its sales that it also recorded in the third quarter due to the temporary impacts of product range transitions and dealers' own initiatives to reduce their inventories. So Stellantis is trying to do a little damage control here. They're saying, oh, we're canceling product lines And that's why our deliveries are down. And also, our dealers are trying to reduce their inventory. So, nothing to worry about. And that doesn't really pass the sniff test because there's a reason why dealers are looking to reduce their inventories because they have too much inventory because they're not selling cars because you made too many of them last year and now they're just sitting on the lot, which means you're going to have to lower prices and you're going to have to start making less of them. Pay attention, guys. Those layoffs in the automotive space, they've already started, and I think they're going to get worse. We've done a lot of coverage of Stellantis on this channel in the last few months. They're having problems with the UAW union again. Cash for Clunkers 2.0. It's coming. It is on the horizon. Stellantis shares are actually up pre-market right now, about a 0.5%, trading at, is this in Euro? This is in US dollars, $12.97 this morning. But don't worry, guys, your wealthy counterparts are doing just fine. Don't let the car deliveries get you down. Don't let the Louis Vuitton thing get you down. Don't let True Value going bankrupt get you down. Don't worry about any of that because the financial elite are doing very well. And once again, they want you to know that you've got it very good. What's your problem? Why don't you understand that? Morgan Stanley tops estimates on better than expected wealth management, trading, and banking results. Morgan Stanley topped analyst estimates for third quarter profit as its wealth management, trading, and investment banking operations generated more revenue than expected. Now, again, guys, look at some of these numbers here and then think about the bankruptcies at True Value, the car deals. Think about the sales in China. All right. Profit rose 32% to $3.2 billion. Revenue jumped 16% to $15.38 billion. The wealth management division saw revenue jump 14% year over year. Equity trading revenue rose 21% year over year. Investment banking revenue surged 56% year over year. It is the best economy ever if you're Morgan Stanley. That's a big if. Now, guys, take that, contrast that with what we just saw with basically the rest of the stream about Chrysler, about LVMH, about True Value. Take that with everything that you have lived in the last year about what your rent has done or about what your grocery bill has done, what your utility bills have done, what your credit card has done. Hopefully not if you're watching this channel. I hope you're not up to your eyeballs in credit card debt, but I know a lot of people are. And then contrast that with all of those big spikes in Morgan Stanley's revenue. And you wonder why you see articles like that one in Market Watch last week that tried to convince you that your groceries were more affordable than they were in 2019. Or articles like Greg Ipps saying it's the best economy ever. What's wrong with you people? All this gaslighting in the financial press. It's all about minimizing the anger of the plebs so that Wall Street can continue ripping everybody off. And well, Morgan Stanley shareholders are getting in on it today. $116.95. That's up $4.75 here, 4.3% higher for Morgan Stanley. It is just the best economy ever. Just ask Morgan Stanley. And I want to say thank you very much to Mighty Mike. First of all, Mighty Mike, thank you for tagging me in that ASML story yesterday. I did see that one. Appreciate that, brother. And thank you as well for the super chat. He says New York Fed Manufacturing Index, negative 11.8. I didn't even catch that one this morning, Mike. But you know what? Those manufacturing indexes, let's bring that up again real quick. Did that one just hit the tape today? Because we have seen those have been negative for quite a while. Where is it? I guess that one was yesterday. I don't see it in today's results. That might have been yesterday, Mike. I'm not going to go hunting around for it. But yeah, manufacturing in the U.S., it has not done well really for like 2.5 years. I mean, if you want to go all the way back to the 70s, it hasn't done well since then either. But a lot of these regional manufacturing indexes have been deeply negative for like 2 dozen months in a row. Not just New York, Philly Fed, Richmond Fed, Dallas Fed. We've seen that across the board. Manufacturing is not doing well in the U.S. It's been doing very, very poorly. Now, some of the services indexes have done well to offset that, and that's why we're not seeing GDP just absolutely collapse. But again, if you take away all the government deficit spending, or if you just reduce the government deficit spending to pre-COVID levels, GDP will turn negative on a dime. It's all just fiscal dominance. It's all prior Federal Reserve monetization of government debts and bets that future government debt is going to be monetized by the Fed. See also gold, see also silver, see also Bitcoin. It's not surprising, but it is paper prosperity. And that's why Morgan Stanley is doing well, but everybody else is doing so poorly because you can't paper your way out of a recession, although they will sure as hell try, won't they, Mike? Thank you very much, sir, for the super chat and the support of the channel. And a shout out to my buddy Nashville Pasta Man. Thank you, sir, for the super chat. I have no idea, Jamie Dimon said about net interest income. Are we being sarcastic there? Did Jamie Dimon? I don't think he's I don't think he said that. Sorry, I got a lot of sun yesterday. I was diving with sea turtles and with my girls. We had a lot of fun. So maybe my sarcasm detector is out of cal today. But I'm going to go out on a limb here, Nashville, and say Jamie Dimon never said, I have no idea on a conference call. Yeah, I don't think they really teach that one in public speaking 101 or in, corporate muckety muck for beginners. I don't know. Is there a handbook for bank CEOs? I'm pretty sure there's a whole chapter dedicated to don't say I have no idea on a conference call. And if there isn't, maybe we want to think about adding that for the second edition, for the next run. I just throw them out there. You guys do what you want with them. Thank you very much, Nashville Pasta Man, for the super chat, the support of the channel, sir. I appreciate that very much. And thank you, everybody, for having your coffee with the Melon Heads this morning. Appreciate the support, guys. Thank you for the generosity in the super chats. Also, shout out to my magnanimous melon heads on Patreon and on YouTube. Thank you guys for everything you do for the channel. Just a reminder, we moved our weekly Zoom call to tomorrow to accommodate the travel schedule. I will be back in the studio mañana. So I'll see you guys tomorrow. Links down below to all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. See you guys soon. Everybody, till next time, live small and dream big.